Hi everybody, it's me again. I just wanted to take a moment to go through a cash flow statement that we've got in the textbook here. As you can see on this screen, we've got the balance sheet and the income statement, and from that I want to generate the cash flow statement. I know it's in your book, but I wanted to go through this to show you how a cash flow statement is done. So as you can see, cash flow statements have basically three parts to it. One is the cash provided from operations, the next one is cash from investing, and the third one is cash from financing. So we start with cash flow from earnings. You got the net earnings, and you can see if I put it that we take the net income from 2014 and put it up there in the beginning of net earnings. And to that we add depreciation, because you know that depreciation is a non-cash expense and it's been deducted from the operations, so we have to add it back in. Now, usually you can find that in the income statement, but in this case it doesn't show that, so they've given us that number of $29,013. Next, we have receivables has increased, and so we have to deduct that increase. And you can see receivables has gone from $59,287 in 2013 to $70,115 in 2014. So that's an increase in receivables, which decreases the cash flow. Okay, and the next one is there's a healthy increase in inventory, going from $554 or $554,389 to $641,280. So that's an increase of $86,891. Next, we deduct the increase in other assets, and that's a very small amount. You see, going from $14,554 to $15,003, only $459,000. Well, I guess that's 459 decrease. Now, the next thing we have to do is take the accounts payable. It has increased, and that supplies a cash for us. So accounts payable has gone from $199,420 to $244,905 for an increase of $45,485. And that increases cash flow. The next, we take the increase. It's not what I want. We take the increase in accrued salaries and expenses, going from $54,123 to $62,725 for $8,602. The next thing we have is an increase in other accrued items. So, and there's small amounts. You can see going from $26,943 to $29,886 for just a $2,943 increase. Then there's a small increase in taxes. You can see where that comes from. Then there's an increase in the current part of long-term debt. And that's this right here, going from $29.68 to $32.58 for $290. Now we add all those up, and it totals $144,562. And this amount is pretty close to the net earnings. And the author points out, if there is a big disparity, that is, if the net earnings is significantly higher than the cash provided from operations, then you have to look at maybe the company's doing something where they're making changes to the books to record more revenues or reduce costs in a way that will make the books look good, the net earnings good in the accrual method of accounting, whereas in the cash flow part of it, it may not support that. And if there's a big disparity between those two numbers, then you want to take a look and find out what management's doing to make that happen. The next thing is our cash from investing, and they had a big increase in property. going from 1,046,461 to 1,340,674, and to that we have to deduct that 29,013, and the reason we have to deduct that is because that 29,000 reduced that 2004 net property, so we have to put that back in there. Now the cash flow from investing or from financing is all due to an issuance of long-term debt, going from 75,628 to 254,529. So you can see what this company has done in the cash flow is they have substantially increased their property, made a significant addition to it, and that was paid for by a significant increase in long-term debt and the results from cash flow provided from operations. So you take all these and you can see the addition of 144,562 less 323,226 plus 178,897, and you have an overall increase of just $233. And that you add to the cash at the beginning of the year, which is that figure right there, and you pluck that off the balance sheet. So you add the 233 to that, and you come up with that 17,201, and lo and behold, that's the same number that we have over here. And that's one way you can reconcile your cash flow statement to your balance sheets to make sure that these numbers, the beginning cash flow plus the addition, equals the ending cash flow for that period of time. Anyway, play with these numbers. I look forward to seeing you in class. Thank you very much.